Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So in today's video, we'll be looking at a tool that can help you escape the market correction and time the market. So this video is strictly for traders only because for investors it will create a lot of noise because due to these signals, because these are short-term signals and they can protect you from the short-term corrections. You'll just for no reason will be selling your stocks, your investment portfolio. So it is not for the long-term traders. It is only for the short-term traders. And if you have some short-term positions and you trade daily or maybe swing trading or positional trading, so it can help you in that. So let's get started with the video. First, let's take a look at the market, the Nifty chart. As you can see, we have been steadily going up from last few months. If you see, the low was this low of around 15,083 was made back in June 2022, and after that the market started going up, and as you can see it is kind of forming a channel, right? Okay, let's take a look at the weekly chart. So you can see after forming the bottom in June 2022, it has been moving in a kind of a channel, and recently only it has broken this channel. If you see here at this point here, if you see at this point here, it has broken the channel, and again it gave a short-term up move. This whole down move of here, this whole down move was corrected in only one day, and the market again started coming up, but again it faced some resistance at this point, and again this is the bottom of the channel. So what typically happens is, here also the rule of supply and the rules of support and resistance apply. So earlier this channel, this lower end of the channel was acting as a support, and once this area was broken, now it started acting as a resistance. So the market is not looking really good, and this whole correction from around 18,890 something to this level of 17,800, this 1,000 point correction caught many people off guard, and I personally myself had to book some losses, and even my trading is not going really that well, so I'm taking a kind of a break move. I have moved in mainly cash. I already had 60% cash, but the I'm selling rest of the 40% as well. I'll be only adding Nifty Bs at some points. So as you can see, this area is really important right now. This area of 17,700, 70 something, and right below this region we have another support, that is the 30-week moving average. So right now the market condition is not that good. If we look at other indices as well, like the bank nifty is also in a similar position. It broke the channel here. If you see, it broke the channel, but again came back up, but faced resistance at this level. So this becomes a really important level for the bank nifty that needs to be taken out around 43,625. Again it started coming down. So currently this whole area here around 41,890, 820 to 41,640 something. This few 70-80 points range is acting as a really good support right now. So the next support will come at this 30-week moving average. Here the price earlier also, during the earlier correction as well, it took support here. But if we look at the mid caps and the small caps, they're not really performing that well. As you can see, the mid cap index, this is the mid cap 100 index. It tried to cross the previous resistance. This is a very strong resistance that was formed back in 2021, November 2021. It tried to cross this level twice, but again, if you see, it fell again. So currently it's moving in this range. In last video also, I made about the correction, I think so. There I told you that the currently the mid cap and the small cap is moving in a range. It tried to break that, but there was no follow-up, and again it came back in the range, and now it is again facing resistance at this level, that is around 31,900 to 32,200 something level. So how can we escape this correction, right? Is there a way? Because many people say it is impossible to time the market, but there are some, you know, tools available that are freely available that you can use to pretty much at least you won't lose that much as you would have lost if you didn't know about these tools. So one simple tool, that is charting. You just have to search Chart Inc. I've already made a video about charting where I explained what charting is, Chart Inc. is, and a custom-made scanner as well. So today I'm going to talk about another feature of charting. So what you have to do is you just have to open the charting and then you come here, you'll see something called Atlas, right? Or there'll be a new sign. You just have to click on that. So there are there you'll see just like the work of charting is, you'll find multiple scanners made by different people according to their own criteria. So what you have to do is there would be a scanner called the market matrix. You just have to click on that. There are 20 widgets in this. So this is scanner that we'll use to judge the market breadth and how we can escape the correction. So here you'll see there are multiple charts, as you can see here, which I'll explain one by one. So first here is the index stats. So this is not that useful. So this one, next we have the 1 year average returns of the sector. So as you can see, the services sector has given the most returns in last 1 years. So what stocks come within this service sector? It'll just tell you about, if you click on this, it'll tell you about the service sector and what are the top gainers and top opportunities in this whole pack. You can just click on this on these sector and you'll get the number of stocks. So but we don't want that right now. We'll just go to the market matrix, and here as you can see we have the 1 year average. So this is the first useful tool that we have, that is intraday stocks above pivot point. So it is also not that useful, but it will give you a rough idea. Change the data point to maximum, that is 375. So it'll give you a rough idea. So during the whole correction, whenever the market was not in a good structure, where the stocks were not performing really well, maybe the Nifty was going up or the bank Nifty was going up, so you think the market is going up, but it will give you an idea about the broader market. As you can see, if we look at the this data is from Jan 4th 2023. So if you look at the chart of the Nifty, so where is Jan 4th? So yeah, during this region, the stocks are not performing that well. They suddenly fell. If you see here, the fall was around 3rd January. They suddenly fell, the number of intraday stocks, like the stocks in intraday, that stopped performing. So it is also not that useful. This one is also not that useful, the intraday candles. So the first important uh, data point that we have is the percentage of stocks above 20-day simple moving average. So how is that useful? Just do the same thing. Show data points, take it to the maximum. So what you will notice is that you can see this broader range around 70% to around 80-90%. So let's take a broad range from 70% to 90%. So whenever the stocks reached the number of stocks that are above the 20-day simple moving average reached this point above 70%, you'll see it was followed by a market correction where suddenly the number of stocks above the 20-day moving average started falling. Like if you see here, April 6, 2022, let's go to the Nifty chart and let's take a look at the April 6, 2022. So what happened here? So this was the time of April, right? So this whole, during this whole up move, if you see, it started from March 8 to April 5, 6, 6, or till 6 April 5, April 5 or 6. It started from around March 4, 5. So if you see here, if you look at this peak, right, if you look at this peak, this was the bottom of the peak, that is at February 24. So when was February 24? So it was around this after this gap down. So the market again fell after that, but if you see the number of stocks above the 20-day moving above their 20-day moving average started improving. So this was on 24th uh, February 2022. The number of stocks above their 20-day simple moving average was 4.757%. But again, if you see, the market fell after that, right? That day the low was around 16,200 something, and after that it fell to 15,600. So there was roughly 500-600% points fall. But if you see, the number of stocks above the 20-day moving average improved to 14.83%. And what happened after that? So after that, forming the bottom on 8th March, the market started going up, 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 and if you see, it topped around 5th April. So what happened here? The number of stocks above their 20-day simple moving average started rising, and then there was a dip that came around 29 March. And if we look at this was the time then when the dip came, this small region here. Let me mark it for you. This during this region, small consolidation in the index, and if you see, it topped around April 6th. Okay, so this was the candle of April 6th. So the index also topped at that time. So if you see, it was kind of a giving you indication that the correction is due. There's a concept of mean reversion that simply means the stocks after some time will converge with their moving average. So that concept also works on different time frames. Like uh, if you see in this, it's working on the 20-day. If we take the 20-day, that is in the short term. In the short term, the it simply means the stocks are away from the their average, their mean. So they'll just come back if they have deviated too much. So again, if you see after that, what happened after this fall? So this was May 13th, May 12, 2022, where when the percentage of stocks above their 20-day moving average fell to 2.97%. So let's take a look at this date was 12 May. So let's take a look at what happened on uh, in Nifty. So if you see this again, this area here, so this was May 12, right? It started falling, and here also it started falling, and this was the bottom. So if you see, you'll ask a question. If you see this, you'll ask a question, because that they are moving, both are moving together. So how can we judge in advance that the market is going to fall or not? So what you can do is you can take a rough estimate, right? So whenever you will see every peak was formed above, whenever this peak was formed above 70% to 80-90%, right? Roughly we'll take the 70%, right? During this December 5, right? This let's take the latest data, December 5, okay, a month back. So when was December 5? So this was December 1st. So it made the top, and this was December 5. So that was a normal correction. This candle also looks good. Many people thought the market is in a good position. Looking at this candle, it's a classic hammer candle, means there's support present, there are buyers present. So but what happened, it went above 70% and it started falling. So and on 23rd December, if you see, it fell down to 7%, right? So this was December 3, and it fell down to 7%. So what it tells you, that you can keep these two broader areas in check, uh, right? Whenever this crosses, whenever this crosses 70%, you can be careful. You can start trimming your position, you can start taking early profits, and you can stop adding new positions. And whenever it reaches this level of below 20%, right? Whenever it reaches below 10-20%, let's keep the 20% as the threshold. So whenever it reaches 20%, you can start looking for the stocks. You can start adding, because the leaders will start performing by then. Whenever it reaches to down to that level, the stocks will start performing, that are the leaders, they'll give you an early indication. So what you can do is, just whenever it is above 70%, you can trim your positions, you can you can start booking profit early. And whenever it reaches around below the 20%, what you can do is, you can start looking for stocks. And whenever it makes a bottom, it reaches around 2-3%, you just have to look for the strongest stock at that time, and you can add that in your portfolio. Because even after that, it can just give you, even if it gives you this small kind of move, like that happened here. So what will happen is that, if you got the leader right, like in this case, the fertilizers were the leaders. So during this dip, right, so this was the dip on 23, 24, 20. So this was 23rd December. So what happened on 23rd December? If you see, it fell down to 7%. So if you look at, this was acting as the leader. So if you added this and kept your stop loss around this level, so the risk would have been what? The risk would have been a very minimum, around, what is this risk? Maybe 8%, or you could have kept your stop loss at this level. So what I'm trying to say here is that, whenever this indicator, the percentage above 20-day simple moving average, reaches down to below 20%, or at the bottom level of below 10%, then what you can do is start looking for the leaders, and you can add a little bit, keep the stop loss very tight, because no, it's not a foolproof plan, but that will give you advantage, right? And similarly, whenever it reaches above 70%, you can start trimming your positions, start cutting your existing positions, reduce your position size, and shifting your stop losses tight, so that you can avoid the maximum damage, and the damage would be minimum. So this is a very simple tool. You can try it as well. I have tried it, and it has been working well. So you can try it as well, and do some experiment with it, and you'll get to know if it works or not. So this was it for today's video. I hope you learned something new, and if you enjoyed the video, don't forget to like, subscribe, and share. And I wish you a very happy new year, and keep supporting me in 2023 as well. Goodbye, take care.